Good morning, ladies and gentlemen. The risk dial absolutely refuses to go positive and is basically stuck around the 0 to -30 area, basically telling you that, you should be continually adding to short maturity bonds and leaving equities well alone. This is, as we've discussed previously, a pattern which sooner or later is going to be broken, and we are either going to have a strong move up like this, or we're going to have a give up of the market and a retest towards the 250 level in the S&Ps, in the SPY. It's too early to tell which way we're going to go, but the model is telling you that this is not the right time to add to the risk on. If we have a look at the deviations, and we have a look at the standard deviations away from SPY, which you should be always looking. This is here for you to spot good areas to buy and good areas to sell. We can see that the 2 times standard deviation comes at 288, so not that far away from where we are at the moment, and we shall discuss that in absolute detail in a few moments. The most remarkable thing that is happening at the moment is the total stability in bond land. I haven't seen a period where the spread between bonds and 10-year notes has been so consistently in a narrow range without any kind of a trend. Is this an inverse head and shoulders? Well, we shall find out. But to me, the fact that they are able to keep the market in such a tight 12 basis point range for months and months and months is an indicator that the bond market is telling us something. I will show you later some other spreads which are very puzzling to me. And I don't know the answer, but to me this is telling me that they are, via this spread, they're controlling the dollar and therefore asset prices. We shall find out in a few years' time what is really going on and what they're doing. But this is very puzzling, and at the end of the day, it tells me that there are no plays to be made in DXY at the moment until this relationship breaks. And here we have the yield on the 10-year note, very much stuck within the day's range of the day before Christmas, when we had the massive rally in treasuries, in the stock market. It is very puzzling that the bond market is doing absolutely nothing and cannot get up off its arse. You would have thought that with the massive rally in risk, you would have had this relationship go out at least towards the 200-day moving average, so trading around 286. Either the economy is doing great guns and the Fed is going to tighten at some stage again, or the market is going to go for a steeper yield curve, or there will be some kind of a pressure on 10-year yields simply because of the huge funding need of the deficit, or for some other reason. Nothing could be further away from the truth. The bond market is telling us that it doesn't want to get away very much from the worst yields that we saw all of last year. To me, that has to be indicative that there is a deeper malaise in the market. If we, as I said before, if we trade this 255 level, which was the low, something very big is going to break. From that level, either we're going to go and collapse down to 233, or we're going to go back up towards the 200-day moving average. When it trades 255, it's really is time, with this level of volatility at an all-time low in the bond market, it's definitely time to buy straddles and long-term straddles and see which way it breaks. This is a weekly chart of TLT, and to me we are still in no man's land. The real bull market opener will be above 127.37, and we are a long way away from that. And the real bear market steepener is going to be below 115.28, and we are a long way from that. So the TLT is very much in no man's land. It's going to be very interesting to see how it trades over the course of the next few months. Simply because if I am right, and I'm going to show you next what I think is going to happen to the bond market, I think we'll probably test both ends of that range. Before we explore the equity markets and the risk markets in general, this is a daily chart of the dollar. To me, the dollar is going to be very important this year, and to me the dollar is one of the main instruments that they are controlling the price of assets at the moment. We have the 96.50 level that is so important in this thicker line, and we basically keep on going from weakness, which is 95.07, to strength, which is 97.54, and then straight back to 96.50. 96.50 seems to be the price that trades eventually. So anything that you do, that you sell above here or you buy down here, 96.50 is the level that it returns to. And that seems to be, at the moment, some kind of an equilibrium price. To me, at some stage, the dollar is going to break this 200-day moving average. It's going to trade through 95.07 and break 93.63. When it breaks 93.63, all hell is going to be let loose, but there is no point in anticipating. As I showed you earlier, they are basically keeping the spread between bunds and 10-year notes almost constant within a 10 basis points range, and while that is happening, the dollar is collared and really can't go anywhere very much. Last week I showed you the euro against the pound, and more or less what I said is coming true. To me, the real area that will be tested on a successful conclusion of the Brexit process is going to be this 84 to 83 area. This is going to be the swing for the whole year. We have the 200-day moving average. If we break through that level and we have a couple of weekly closes below, we could really make a quick run all the way down to this kind of level, which is like 77. At the moment, you know, it's going to take quite some time for that to happen, but the 88, 89 level seems to be a very good sell area, unless something ridiculous happens with Brexit. We definitely will trade this 83 to 84 area, and since you have positive carry in sterling, sterling is certainly going to trade better than the euro for the next foreseeable future. And on to the US equities. We are approaching now the level that I think is going to be the most important level of the year, and that actually is 28.64. I've been saying 28.61, but what's 3 ticks? 28.64 is the level, and because I was using futures prices earlier, but now I'm using cash prices because those are even better. 28.64, as you can see, it's a level that we peaked at back in, what was it, January of 2018. We just collapsed from there. Then we spent the whole year getting back to it. We tried getting above it for 3 whole days, failed, came back, got some more momentum. We broke it to the upside, went slightly higher, came back to it, rested on it for 3 or 4 days, tried to make new highs, and then just collapsed through it. When we collapsed through that level, we just gave up everything and we had the nightmare. Now we're getting back towards 28.64, which is to me the scene of the crime. The bear market started the day we broke 28.64 on the downside. I always use the 28.61 because that's where my stops were in in the futures, and I got filled at like 28.57, and I was saying, what the hell is going on? Because even a 2-tick move in those days was a big deal. And when that happened, to me, it was clear that volatility was going to change quite dramatically, and you will see what happened to volatility on that day. And I think there is zero chance that we get to 28.64 and not have some kind of reaction off that level. That is going to be the level that I put on some very heavy positions in the options and look for a strong reaction off it. Having said that, the market has spoken. We closed above 28.12 and 28.15 on Friday. This is the cash, 28.22, futures 28.30. We are now likely to go up and test that 28.64 level during the course of next week. And volatility being this low, it's going to be an ideal time to put on some options positions. I don't think we reach the 28.94 level, which is the top of the Bollinger Band on the weeklies. I think we'll fail at the 64 level, and I think we will come back down. How much will we come back down? Well, the ideal to me would be to retest this blue line, which is around the 27.40, might be 27.50 or 27.60 level sometime over the course of the next couple of weeks when we retest it. To me, the range for the next couple of weeks is going to be the 28.64 down to 27.40, 50, 60 area. I've been telling you for a few weeks that the canary in the coal mine this whole time has been the European market, the DAX and the stocks, which, having been the weakest for such a long time, have been refusing to go down. And I've been saying, do not be bearish of Europe, because it just doesn't want to go down. If Europe doesn't want to go down, the odds that the States will go down are not that good. And so it has come to pass. If we now just enlarge this chart of the DAX, this is a weekly chart, we will see that basically we have a neckline here around the 11,800 level. We have the Bollinger Band, the upper level of the Bollinger Band. We have these very important moving averages all coming down between 11,700 odd and 11,900. This is going to be a wonderful area to play with options, because either in the long term the market tops out exactly here around 11,800 and comes and tests back down towards 11,700, or after a bit of consolidation it breaks through and goes all the way to 12,500 and then 13,000. There is not much in between those two scenarios. Those two scenarios will be dictated by the performance of the economy, and that actually matches in with what I've just showed you for the United States. We go back up to 28.64, retest there, come back down towards the 27.50 level, and then the actual performance of the economy dictates what happens from there for the remainder of the year. But 28.64 is the level in the S&Ps, and 11,800, 11,830 is the level in DAX. Amazing how the two match up so well in terms of time and in terms of performance. The more things match up, the better it is for any thesis. Here we have a weekly chart of the VIX. We never went below 1150, let's call it, in terms of price throughout that rise from call it February 2018 all the way into October of 2018. This is that weekly candle that I told you about, that when we broke through 28.64 on the downside, and we started the bear market process, and this is basically the return to the scene of the crime. And it would not be surprising to see a quick dump in volatility back down towards the 11 area over the course of the first few days of the week, and then slowly a return back up towards 14, 15, 16. That is why I don't think that we are going to have a complete nightmare in the S&Ps. I think all we're going to have initially is a reaction from 2864 of 75 points, i.e. 3%, which would be a normal correction, and then we see what happens. I want to leave you with something which is a dilemma to me, and something which I have no answer to at the moment, but something for you to think about. This is a weekly chart of the spread relationship between XLU, so utilities, and XLP, consumer staples. You would have thought that the relationship between the most boring stocks and utilities, which are in themselves yield sensitive, would be quite constant. And it's not. It's quite volatile. Not as volatile as a lot of other things, but quite volatile. You can see that this here was over 150 and this here was below 90. So that's a 60% swing between 2008 down into 2016, and now we are, well, a good 20% off the lows, probably 25%. You would have thought that a time when there is growth, when stocks are performing pretty well, that the relationship between XLU and XLP would be actually declining. We have now what many call the best part of the business cycle, and utilities are outperforming the consumer staples. Consumer staples are your brand names, the Coca-Cola, Pepsi, Procter & Gamble, while the utilities are your boring electricity companies and stuff like that. Now, why is that happening? What is that showing? I have absolutely no idea. But you will see how the price of the utilities actually outperformed the price of staples going into the last recession. To me, that I really have no answer why that is happening. It is something for you to consider and think about. What is this spread telling us about the long term? Why should people prefer to buy the most boring yield sensitive things unless they are anticipating at some stage in the future a very bad market reaction from equities, and even the most boring equities which are out there, the ones that would be least susceptible to price falls during a bear market? I really don't know. To me, this is a puzzle. We shouldn't be trading this far above the lows. We should be trading somewhere here, but that is a good 15% different, and people keep on buying utilities, keep on buying utilities, keep on buying utilities. If anyone has any ideas, I'd love to hear from you. To me, this is probably the most bearish sign. And so on to our biases for next week. We are getting close to this 255 level in the 10-year note in the States, where with volatility as low as it is, you have to do straddles. It is just a given, because from there you will see at least a 20 to 30 basis point price reaction over the course of a month. So that is what I will be tweeting to you about next week. Now the SPX, 2861, well, let's put in 2864 to be absolutely precise. I did say over 2812 we go to 2864. That is where we're going. From there, I told you what my strategy is, and I will be tweeting you the levels and the options that I'll be doing. Here, volatility 1175 is on deck. I've been saying it for weeks. Even probably 1150 in the cash. But even the futures, a few basis points above that, are going to be worth buying. 11,800 in the DAX is going to be all important, and I'll be definitely buying some put spreads there, and I will tweet them to you. Nothing has changed in the dollar. I told you what the important levels are: 95.07, 93.63. Those are the very, very important levels, with 94.90 now as the swing. Below 93.63, which won't happen over the course of the next week or even two, all hell's going to break loose. I don't know why, but it will. And this is the one that I'm still looking for. 83.84 is where I want to take the bulk of my profits in Euro GBP. Have been short of it, and only if it goes above 88.30 will I be worried in the slightest. Positive carry, stick with Euro GBP. There is very little risk in that trade from what I can see. Thank you very much indeed, and tweet you on Monday.